Hey everyone, and welcome to our complete guide on investing for beginners in the USA. If you've ever wondered how to make your money work for you, you're in the right place. Investing is one of the most powerful tools for building wealth and achieving your financial dreams. But before we dive in, a quick disclaimer. I'm not a financial advisor, and this video is for educational purposes only. Always do your own research or consult with a professional. Alright, let's start with the basics. What exactly is investing? Think of it as buying a small piece of a company's future success. The most common way to do this is through stocks. When you buy a stock, you're buying a share of ownership in a public company. If the company does well, the value of your share can go up. There are different types of stocks, like growth stocks from companies expected to grow quickly, value stocks that might be undervalued by the market, and blue chip stocks from large, stable companies. But stocks aren't the only game in town. There are also bonds. When you buy a bond, you're essentially lending money to a government or a corporation. In return, they promise to pay you back with interest over a set period. Bonds are generally considered less risky than stocks and can add stability to your investment portfolio. Now, what if you don't want to pick individual stocks and bonds? That's where funds come in. Let's talk about mutual funds, ETFs, and index funds. A mutual fund pools money from many investors to buy a diverse collection of stocks, bonds, or other assets. They're managed by a professional fund manager. ETFs, or exchange-traded funds, are similar, but they trade on the stock exchange just like a regular stock. This means their price can change throughout the day. And then there are index funds. These are a type of mutual fund or ETF that aims to track a specific market index, like the S&P 500, which represents the 500 largest companies in the US. The beauty of index funds is what we call passive investing. Instead of trying to beat the market, you're simply aiming to match its performance. This strategy often comes with lower fees and has a great long-term track record. Before you invest a single dollar, it's crucial to know what you're investing for. Let's talk about setting your investment goals. Are you saving for a down payment on a house in 5 years? That's a short-term goal. Or are you planning for retirement in 30 years? That's a long-term goal. Your timeline will heavily influence the types of investments you choose. Along with your goals, you need to assess your risk tolerance. How comfortable are you with the idea that your investments could go down in value? If the thought of a market dip keeps you up at night, you might have a lower risk tolerance and prefer safer investments like bonds. If you're okay with more volatility for the potential of higher returns, you might lean more towards stocks. There's no right or wrong answer. It's all about what's right for you. Once you know your goals and risk tolerance, you can start thinking about strategy. The number one rule of smart investing is diversification. You've heard the saying, don't put all your eggs in one basket. That's exactly what diversification is. By spreading your money across different types of investments, industries, and even countries, you reduce your risk. If one part of your portfolio is down, another part might be up, helping to balance things out. Another powerful strategy, especially for beginners, is dollar cost averaging. This just means investing a fixed amount of money at regular intervals, say $100 every month, regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more. Over time, this can lower your average cost per share and takes the emotion out of trying to time the market, which is nearly impossible to do consistently. This brings us to the long-term versus short-term investing mindset. While some people try to make quick profits by trading frequently, history shows that a long-term approach is often more successful and less stressful. By staying invested for years, you give your money time to grow and ride out the inevitable ups and downs of the market. This is where the magic of compound interest really kicks in, allowing your earnings to generate their own earnings over time. So, you're ready to start. How do you actually buy these investments? You'll need an investment platform, also known as a brokerage account. When choosing a broker, consider things like fees, the types of investments offered, research tools, and how easy the platform is to use. Some popular platforms for beginners in the USA include Fidelity, Charles Schwab, Vanguard, and app-based brokers like Robinhood and Webull. Each has its pros and cons, so do a little research to see which one fits your needs best. Now for the exciting part: building your first portfolio. A great starting point for many beginners is a simple, diversified portfolio using low-cost index funds. For example, you could start with a total stock market index fund to get broad exposure to US stocks, and perhaps a total international stock market fund for global diversification. If you have a lower risk tolerance, you could add a total bond market index fund to the mix. The key is to start with a plan based on your goals and risk tolerance. Once your portfolio is set up, your job isn't completely over. It's a good idea to check in on your investments periodically, maybe once or twice a year, to see how they're performing. This is also a good time to rebalance. Let's say your stocks have done really well and now make up a larger percentage of your portfolio than you originally planned. Rebalancing means selling some of those stocks and buying more of your other assets, like bonds, to get back to your target allocation. This helps you manage risk and stick to your strategy. As you begin your journey, there are a few common mistakes to be aware of. The biggest one is emotional investing. When the market is soaring, it's tempting to get greedy. When it's falling, it's easy to panic and sell. Making decisions based on fear or excitement is a recipe for disaster. Stick to your plan. Another mistake is not doing your research. Don't just invest in something because you heard about it from a friend. Understand what you're buying. And finally, watch out for high fees. Fees might seem small, but over decades, they can eat away a huge chunk of your returns. That's why low-cost index funds are so often recommended for beginners. So let's do a quick recap. We've learned that investing is crucial for building wealth. We've covered the basics of stocks, bonds, and funds like ETFs and index funds. We talked about setting goals, understanding your risk tolerance, and key strategies like diversification and dollar cost averaging. We also touched on how to choose a broker, build your portfolio, and avoid common pitfalls. Your next step is to take action. Start by defining your financial goals. Then, open a brokerage account and begin investing, even if it's just a small amount. Using a strategy like dollar cost averaging into a diversified, low-cost index fund. The most important thing is to start and to keep learning. Investing is a marathon, not a sprint. Be patient, stay consistent, and you'll be on the path to a brighter financial future. Thanks for watching, and don't forget to like and subscribe for more content to help you on your financial journey.